Europe's venture capital isn't fast enough. Let's talk about it now. Hi, I'm Oliver and welcome back to the channel AskMeStartup, where we talk about startups, small businesses and the world that surrounds them. If you're new here, please consider subscribing and pushing the notification bell so YouTube lets you know whenever we're uploading new content. Please feel free to download our free startup checklist, link in the description below. Okay, today's topic, Europe's venture capital isn't fast enough. When we started our company back in 2014, the time frame from a venture capital to say yes or no wasn't measured in days or weeks, but rather in months. This has somewhat slightly changed, but still isn't where it should be. As a very good starting point, we can go back to a study that has been published in HackerMoon, where they actually asked entrepreneurs and venture capital companies on what is important when they want to interact with each other. And of course, on number one was the personality and the chemistry in between both of them. But then the entrepreneurs ranked on number three, the speed of the process. They need the money fast to progress. Whereas the venture capitals, they said speed was on the lowest priority of all. Now you can see that discrepancy actually is problematic. Why? Because entrepreneurs actually have to move fast. They have to keep their first mover advantage very often. And sometimes it is just a matter of weeks or months if you're better off than your competitors. Hence, venture capitals, especially in Europe, need to speed up their game. And are they doing so? Yes, they are getting better, but we're still not there where we should be. First of all, anyway, in Europe, we usually tend to have smaller ticket sizes than we do in the US. That shouldn't be a problem in itself, but also that includes that the landscape isn't as sophisticated as it has been. And then there's a new interesting trend now these days, as what people call solo capitalists are now in the game. They very often lead the investment rounds instead of venture capitals. Why is that? Most of the time, those very wealthy individuals are much faster in accepting or bringing up a term sheet and doing their due diligence. For that specific purpose, they do set up maybe even their own vehicles and bring up other friends, etc. And I can tell you from our experience that yes, we mainly have those single capitalists in our company, people that are much faster in committing the funds to a startup. But why are the VCs then not fast enough? Well, first of all, they have to do their due diligence, which in fair terms everybody needs to do. But they are also obliged to take very good care of the capital that is given to them by pension funds, universities, governments, rich individuals, whosoever. So now the question comes, what can venture capitals do to get faster and not being left out? Because the best entrepreneurs are not called the best entrepreneurs because they're slow and waiting for the venture capitals forever, right? So the fastest tickets these days, if you're lucky, can be done within 9 days. But what is it that leads to that? So what we see is that venture capital companies in Europe take sometimes a FOMO approach, the fear of missing out. They blindfolded jump onto any train, any opportunity that just somewhat suits them, and then they're off just to not miss the ticket. That of course is a very risky strategy because it also means that not all or many of those endeavors will not work out for them. The second approach, and that is really harmful, is they hand out a meaningless term sheet very fast. That term sheet is, claiming to give you exclusivity, but in reality, it's just keeping you down, blocking you from all other venture capitalists to enter your round, and giving the venture capital that handed over the term sheet to you some extra time to do their due diligence. Which could result that in 30 to 60 days, you're left with nothing because in the due diligence, something came up and popped up that they didn't like. That is not good because it actually takes away the chances of the entrepreneur to move on in its essential pace that it needs. So what can people do? Well, It turns out that some venture capitals have realized the problem and the issue because they have been left out. And they are now approaching things differently. How? Well, for instance, if they see some promising pitches, they actually have more people on the due diligence. So to reduce the time needed, which means that they need to adjust their processes and hopefully get the information that they usually collect in a week's time, in a couple of weeks' time, down to 5 to 7 days' time. At the end, no matter how venture capital companies are doing it, they are a service provider to the entrepreneurs with the capital as the source of help. They shouldn't block them from speeding up or achieving their goals, right? Of course, if you're a crappy entrepreneur or your project isn't worth it, they have all the right in the world to say no, but they can do so much, much faster than they're doing it right now. All right, everybody. I hope this was a helpful short introduction into 3 minutes why venture capitals are too slow in Europe. If you have had similar experience, just drop a comment down below. I hope to see you next time.